Hello and welcome to our deep dive into continuation funds, a topic that's rapidly reshaping the private equity landscape. If you're an investor, fund manager, or finance professional, this video is designed to provide you with a clear, in-depth understanding of why these funds have become so significant. Continuation funds are one of the most talked about trends in private equity, but why are they gaining so much traction now? The private equity market faces a fundamental tension. Investors increasingly demand liquidity, while fund managers seek longer time horizons to maximize the value of their best assets. This tension has driven the explosive growth of continuation funds, making them one of the fastest-growing segments in the private markets. They solve a core tension between the need for early exits and the desire for long-term compounding of value. Let's start by defining what continuation funds are and how they actually work. A continuation fund is a new vehicle created by a general partner or GP to acquire one or more assets from an existing fund. This differs significantly from traditional fund exits. Instead of selling an asset to an external buyer, the GP effectively buys it from themselves, moving it into a new fund. This new fund is called a continuation fund. This is different from a standard exit, where assets are sold to an external buyer, typically through an M&A process or an IPO. Continuation funds are GP-led secondary transactions. This means existing limited partners, or LPs, have options. They can cash out, roll over their interest into the new fund, or partially reinvest. They are typically structured with new capital from secondary investors who provide liquidity to LPs who want to cash out, alongside rollover from LPs who choose to stay invested. Now, let's explore why general partners are increasingly opting to create continuation funds. One primary reason is to retain, quote, trophy assets, those high-performing companies that still have significant growth potential but are nearing the end of a traditional fund's lifecycle. By moving these assets into a continuation fund, GPs can extend the value creation period, preserve their track record, and maintain their fee streams. This creates continued management fee streams and carried interest opportunities that would otherwise cease if the asset were sold. For LPs, these transactions offer a choice: cash out, roll over their interest into the new fund, or partially reinvest. For GPs, continuation funds offer strategic flexibility, allowing them to optimize portfolio management and better align with the long-term growth trajectory of their best assets. For LPs, the main benefit is a liquidity option for their investments without being forced into an exit at a potentially suboptimal time. However, continuation funds are not without their risks and challenges, including potential conflicts of interest, valuation disputes, and increasing regulatory concerns. Valuation is often the most debated issue. GPs may face accusations of overpricing assets, making independent valuation critical. A key challenge is the potential for conflicts of interest, as the GP acts as both the seller from the old fund and the buyer for the new continuation fund. Regulators, like the SEC and FCA, are increasingly scrutinizing continuation fund processes to ensure fairness and transparency for all parties involved. There's also a risk of overconcentration for LPs if they roll over a significant portion of their investment into a single asset. Let's look at some real-world examples from major players like Blackstone, Carlyle, and Ardian. Blackstone has notably used continuation funds to extend exposure to its successful life sciences and infrastructure platforms, showcasing their strategic flexibility. Carlyle has also leveraged continuation funds to extend holding periods for certain technology and healthcare investments, maximizing their long-term returns. Ardian has been a leader in European GP-led secondaries, managing multi-billion-dollar deals and demonstrating the market's maturity. Each of these cases demonstrates the scalability and mainstream adoption of continuation funds as a core tool in private equity. So what does the future hold for continuation funds? We'll examine their growth trajectory, institutional adoption, and the evolving regulatory scrutiny. The market for continuation funds is expected to grow significantly, potentially exceeding $150 billion annually by the late 2025, driven by increased GP and LP comfort. Increasingly, institutional investors like pension funds and sovereign wealth funds are allocating specifically to GP-led secondary deals, recognizing their unique value proposition. Regulators will likely impose greater disclosure requirements and stricter guidelines to protect LPs and ensure market integrity. Continuation funds are evolving from niche liquidity tools into a core pillar of private equity fund management, essential for long-term value creation. In conclusion, Continuation funds offer compelling solutions for both GPs and LPs, bridging the gap between fund life cycles and long-term asset value. They represent a significant evolution in private equity. Remember, this content is for educational purposes only and not financial advice. Always consult with a qualified professional before making investment decisions. Thank you for watching.